Good morning, ladies and gentlemen, and welcome to Dexco's conference call, where we will discuss the earnings for the first quarter of 2025. This conference call is being recorded, and this recording may be watched on the company's investor relations website, ri.dex.co. This presentation is also available for download there. This call is also available in English. If you need to watch the English translation, please click on the globe icon and select English. After that, you may also mute the original audio. We'd like to inform you that all participants will be in listen-only mode during the company's presentation. After that, we will begin the questions and answer session when further instructions will be given. Before we begin, I'd like to reinforce that any statements made about the future are simply based on the company's assumptions and beliefs, and on information currently available for the company. These statements may involve risks and uncertainties as they refer to future events, which therefore depend on circumstances that may or may not occur. Investors, analysts, and the press should take into account that events related to the macroeconomic scenario, to the industry, and other factors may make these results materially differ from those expressed in these forward-looking statements. We have with us for this conference call Dexco's Executive Board and Investor Relations team. I would now give the floor to Francisco Semeraro, CFO, who will begin the presentation. Please, Francisco, go ahead. Good morning, everyone. Thank you for joining us for another Dexco earnings call. I'm here with Raul Guaragna in his first call as CEO and the other members of the board. We will begin the presentation with slide 3 with our main headlines, starting with the pro forma adjusted and recurring EBITDA, which totaled 611 million in the first quarter of 2025, considering LD Celullose's 49% of EBITDA, of which 346 million corresponded exclusively to Dexco's business. This result reflects the resilience of the wood division, even without the realization of forestry business in the period, and the operational consistency of LD Celulose. On the other hand, we saw pressure on the finishing division's results due to the natural seasonality and the lower dilution of costs, in addition to sectoral challenges still facing the coverings division, as we will see later. The first quarter performance is consistent with the fourth quarter of 2024, and the first quarter of 2024 included the forestry business impacting revenue and EBITDA, which was not the case either in this quarter or the last quarter of 2024. Continuing with cash flow on slide 4, we were able to partially offset the lower operating generation this quarter by carrying out efficiency actions in working capital, with improvements in the customer and supplier lines and greater financial discipline. Working capital to net revenue had a total of 16%, which was a level compatible with the first quarter of 2024, which was 17%, and in line with what is expected for this time of the year, where there's typically a buildup of inventories in the divisions after year-end vacation breaks. Sustaining CapEx in the first quarter was in line with 2024 in forestry OpEx and maintenance costs. In the first quarter of 2025, there was a concentration of maintenance downtime in panel operations. With regard to expenditures linked to the investment cycle starting in 2025, in the quarter, we invested 25 million in the new plant in Botucatu, which is already in the ramp-up phase, as we announced last quarter. 18 million in modernizing the metals and sanitary ware operations, as well as 8 million in expanding the forestry base in the Northeast, and 3 million for DX Ventures. It's worth noting that the CapEx levels for this quarter are in line with the same quarter last year, and with the end of the investment cycle, disbursements related to this line will be substantially lower in 2025. Continuing with slide 5, which discusses our corporate debt. We had an increase in the leverage indicator, which ended the quarter at 3.45 times net debt to EBITDA, reflecting lower operating cash generation and investments in projects. The average cost of debt reflects the behavior of interest curves pressured by the unstable macroeconomic scenario, especially with higher short-term interest rates here in Brazil. The composition of our debt remains heavily weighted towards long-term debt and annually balanced maturities. We maintained an average maturity of 4.1 years and continued to balance costs and maturities to improve liability management and preserve the company's financial health. Continuing with slide 7, starting discussions on the wood division. According to IBÁ data, the domestic panel market continued to grow compared to the first quarter of 2024, with growth for both MDF and MDP sustained by the heated demand coming mainly from the furniture industry. On the other hand, the foreign market shrank, mainly due to international macroeconomic instability, which reduced the appetite for higher value-added imports. Turning now to the division results on slide 8. We ended the quarter with an adjusted and recurring EBITDA of 350 million and a margin of 27.2%. Here we have some important messages, such as the fact that in the first quarter of 2024, forestry deals were carried out, which ended up impacting the comparative base for the period. We therefore are presenting a pure result for panel operations in the first quarter of 2025, reinforcing the consistency of our operations. The most important point is the profitability we were able to achieve this quarter, confirmed even in comparison to the fourth quarter of 2024. We posted a very similar result to the last quarter of last year, with an increase of 0.8 percentage points in the adjusted and recurring EBITDA margin, reinforcing our commercial strategy, considering, of course, the usual seasonality at the end of the year. The results of the last quarter of 2024 showed commodity cost pressures in dollars. These pressures eased in the first quarter of 2025, and we went through the combination of the two quarters with sustained margins through a correct strategy of price positioning, product mix, and a robust client portfolio. We also need to highlight that this quarter we have already carried out scheduled downtime maintenance stoppages at some of our plants, which has an impact on the dilution of costs and volumes. I would like to point out that the scheduling of maintenance stoppages is aimed at manufacturing efficiency and the best arrangement for meeting market demands, which is why in 2024 they were concentrated at the end of the year. Continuing with LD Cellulose. The operation continues to show a strong operational performance, a net revenue of 843 million, and an adjusted and recurring EBITDA of 542 million, a margin of 64.2%. This reflects the normalization of operations compared to the first quarter of 2024, which was a period impacted by scheduled maintenance stoppages, as well as efficiency and productivity gains that have been sustained over the last quarters. Net profit also made a significant advance, reaching 252 million in the first quarter, representing the LD's robust operational performance and the one-off accounting effect related to the evolution of the exchange rate in the first quarter of 2025 compared to the fourth quarter of 2024. We now turn to slide 11, where we will talk about the sector environment for metals and sanitary ware. The construction materials sector is showing signs of recovery in the recent quarters, driven, for example, by the progress of housing programs in the country. According to Abramat data, the industry ended the quarter with a growth compared to the first quarter of 2024, with sanitary ware standing out, finished products specifically. However, it's worth noting that we have seen a down-trading movement in these products, where those with lower added value ended up having a greater weight in the consumer's purchasing options. In this sense, even with growth, we understand that the current economic scenario is still not favorable, with the short term proving to be quite sensitive. Continuing with the metals and sanitary ware division results on slide 12. In the first quarter of 2025, we posted a positive adjusted and recurring EBITDA of 8 million, reversing the negative result we had seen in the same period last year. This reflects the gain in market share in higher added value categories and the improvement in the product mix, which contributed to a growth in net revenue compared to the first quarter of 2024. In the first quarter of 2024, the electric showers and taps operation was still in our results, and they had a significant impact on the division's volume. As communicated in the previous quarters, we left the segment in the second half of last year, and when we disregard this operation in 2024, we saw a volume growth of around 6% and a revenue growth of the same level. From an operational point of view, the metals segment continues to be a highlight in occupancy, increasing efficiency and contributing to robust margins within the division. We captured information on an increase in sell-out in the quarter, accompanied by an increase in sell-in, which indicates a healthy replenishment of our customers' inventories and good positioning of our products under the Deca and Hydra brands. This move was strategic and in line with our working capital composition policy aimed at improving service levels. Now, continuing with slide 13, we have the tiles sector environment. The ceramic tiles segment continues to face a challenging scenario. Although the wet market where Dexco is present has showed a growth for the quarter, this was driven above all by significant sell-in actions in January, accompanied by significant reductions in the price levels charged and drops in volumes in subsequent months. Even so, the sector as a whole was impacted by the retraction of the dry market and high levels of stockpiling, which put a pressure on capacity utilization and intensified competition in the market. So profitability challenges remain high for the entire industry. Let's continue with the results for the tiles division. This quarter, we maintained our commercial initiatives to recover market share, and this resulted in volume growth. But the high levels of competition in the sector impacted both the composition of the product mix and price levels, which resulted in a drop in net revenue. Another relevant point when it comes to costs was that, as expected, this quarter was marked by the ramp-up of the new Botucatu plant. Considering the integration of this new operation, maintenance downtimes at the end of the year in the south of the country were extended until mid-January in order to readjust the production and portfolio. This had a direct impact on the cost dilution and, as a consequence, on the results for the period. Thus, we ended the first quarter of 2025 with an adjusted and recurring EBITDA of negative 12 million, reflecting a combination of the competitive environment and an increase in costs. Here, I'd like to point out that we continue to pay close attention to the performance of the new Botucatu unit, focusing on operational efficiency and value-added products, which should contribute to the gradual recovery of these results. We now continue on slide 16, which discusses our prospects. I'd like to highlight the main prospects we will see for the coming quarters of 2025. The wood division continues to have solid fundamentals, supported by resilient demand from the furniture industry. We are maintaining our strategy of focusing on a higher value-added mix and expect to maintain the good profitability levels we have seen so far. At LD Cellulose, the operation maintains consistent performance with high levels of efficiency and productivity, even in face of a more volatile global scenario. We are confident in the stability and competitiveness of dissolving pulp compared to other fibers, and especially in LD's attributes to face the competitive environment. In the finishings division, commercial actions aimed at optimizing the portfolio and improving the use of industrial assets should contribute to the gradual recovery of results, especially as the ramp-up of the new tiles plant progresses. In this context, the Casa Dexco concept store is positioned as a relevant factor for profitability, strengthening our presence among retailers and some of our public. We have continually invested in products that differentiate ourselves from the market with technologies and applications that expand our premium portfolio, such as the Petra and Portinari brands, which are large and replace materials with great advantages. These launches bring significant advantages to Dexco's positioning at this time and allows for product diversity, higher margins, and reinforces our competitiveness in different market segments. From the macroeconomic point of view, maintaining interest rates at high levels reinforced by What was announced last night by Copom continues to impact the economy in general, especially the construction sector. And as a consequence, the demand for finishing products, especially the most price-sensitive ones. This is certainly negative for our industry, and there's still a lot of uncertainty about the future, which generates uncertainty for decision-making by our customers and the end customers of Dexco products. On the other hand, standing timber prices remain stable, still at historical high levels with no signs of changes in the short term. And that's why we continue to prioritize capital discipline, focusing on cash generation and reducing leverage now that the investment cycle is coming to an end. We remain committed to operational efficiency and the creation of sustainable value. Thank you. We will now begin the questions and answer session for investors and analysts. If you would like to ask a question, please click on the raise hand button. If your question has been answered, you may remove yourself from the queue by lowering your hand. The first question will be asked by Ms. Tatiane Candini from JP Morgan. Go ahead, ma'am. Good morning. Good morning. Thank you for taking my question. I have two. The first is about the wood segment. We have seen an improvement in demand when it comes to wood panels. So looking at the results, there seems to be an improvement and a resilient demand, as you mentioned. But in the second quarter, how has that been doing in the first month? And also thinking about the second half of the year. As you mentioned, interest rates are impacting the macroeconomic scenario. So what parameters are you keeping track of to decide on if you will sell standing wood in the next quarters? And how much in advance does that decision need to be made? Or can you do it quickly? My second question is about wood tiles. Since the end of the COVID pandemic, after 2022, this segment has suffered from competition, price pressures, and in some quarters we have seen better results than others. So we've been talking about a turnaround, but we still haven't seen consistent results. I know that Botucatu is coming online, but when do you expect to reach stability so that we can think about the long term with a bit less volatility? Thank you. Thank you for your questions. So we're going to give you a panorama of the wood division and LC. So first, we will get an answer from Henrique Haddad, and then Raul will answer your next question. Hello, this is Henrique Haddad. So speaking about demand, what we have seen is that there is some resilience. We're learning about seasonal patterns again. In the last few years, we have been used to being surprised between the first and second part of the year. And we've tried to keep track of that. What is happening now is that we have had better performance in the industry with planned furniture, and as a consequence, retail. This has been a reality in the last quarters. And in wood, where we have a significant part of our sales, we're also having a solid performance. But we need to be closer to consumption due to reforms and refurbishings. As you know, it's still early to make any mapping. Once again, interest rates are going up. This is not a positive message. But we are looking at employment levels. We're looking at supporting the Minha Casa Minha Vida program launches, and this generates a very positive mood in the market. So we don't have any bad news. We don't see any catastrophes ahead, but it's hard to foresee trends. On the wood division for the last few months, we have been seeing that we don't have excess wood for sale, as happened in 2023 or 2024. But what we do is daily work trying to find opportunities in buying and selling wood. We're trying to find the best availability, the best radius for sales, but this is not something that we can plan too far ahead. This is something that could happen as we have excess wood, but that is not the case currently. But there's nothing that can generate significant results due to the position that we have. Hi, Tatiani. Thank you for that question. Just to add to what Enrique said about the wood division, I'd just like to remind you of our practice of having optimal occupation, which is what we have been using since 2022. So as you can see, in the last few quarters, we're at a healthy profitability level for panels. But of course, when you look at the long tail of the last few sales, you may see some pressure on volumes, and that can get in the way of profitability. So this is the optimal occupation level. If we are aligned with our market share and our capacity, and if we're at a good occupation level, we're always going to focus on panels. If at any moment we have a pressure in demand, and if we have to force a volume that does not exist, then this wood lever is an exclusive capacity that Dexco has since we're self-sufficient. We have a very effective forestry plan. It is very well done. So we know what are the candidate blocks for sales. And we have a forestry team that assesses the business. Of course, as Enrique said, this is not immediate. So there are contracts, there's ownership. It's not something that you can do very quickly, but you can do it when the scenario allows for that. So it's important to understand that, but I'd just like to highlight how stable and healthy the panels business is. That really is at our core. So continuing with your second question on ceramic tiles, I think you have a very relevant point. When we look at the tiles system, we have been experiencing some very unique years. So since we started in the division in 2007 to 2009, or excuse me, 2017 to 2019, 2021 was very positive, but there was a high concentration of new capacity. And that came along with a downtime where inventories are being built throughout the chain. So for over 10 quarters, we have been seeing occupancy rates around 60-65% for the industry. It will probably not be above 70 to 80%. So it's a bit erratic. At some point, competitors get pressured on cash flow and they end up stockpiling. And then in the next quarter, you see a hard landing for the industry. We saw this in January as the wet market increased its demand. Afterwards, you saw a reduction. So this erratic behavior means that we need to be very precise in how we organize things. And moreover, we were also impacted on this side. And the last one, as you know, was Botucatu. Botucatu was a bet that we want to reinforce as the right one. This is a unit that will strengthen our participation in the premium industry. And in new segments where we did not work, such as ultra compact and Portinari and Petra, which is a new line of products and minerals. And this is a new category that is absolutely new, which is 20 to 30 million meters in capacity. So the addressable market is around 20, 30 million. Of course, you have to have a product distribution method, but of course, this happens over time. In this quarter specifically, as Francisco mentioned, we had some downtime. December and January, we were down, and that had a cost. So we have to transfer items to São Paulo. So we can say in this quarter that there are new elements, as we had before, that bring us to a level that is much lower than we imagined. It's very important to have long-term consistency, selecting the markets where we should participate, the higher added value, the higher value added market. Of course, we can't sell products below our production costs, and so we have to be flexible, understanding where we can work, but we're also dominating this high value added part of the chain. So we have a unique possibility there. And long-term perspectives, what I can say is that we're happy with our strategy. We have flexibility in adapting ourselves, and we will definitely have a very difficult year until the market settles, but we are definitely seeing sequential improvements starting in the second half of 2025 and the first half of 2026, when the Botucatu system is completely online. Thank you, everyone. Thank you, Tatiane. The next question will be asked by Marcelo Arazi from BTG Pactual. Good morning, everyone. We have two questions. I'd like to talk about cash generation and leverage. We see that the company's leverage is going up slightly, so I'd just like to see how you're seeing this advance throughout the year. If there are any initiatives that can accelerate this deleveraging process that is not based on operational improvement. If you are talking about selling assets, and if there's anything you can tell us about that. Talking about cash flow, we saw that your generation is a bit pressured by working capital. We understand that there is a seasonal effect in the first quarter, but we'd just like to understand how you believe working capital will evolve in the future. Thank you. Thank you for your questions, Marcelo. Let's start with cash generation and leverage. Of course, we created our plans for 2025 with a composition of businesses that will allow us to follow our strategic direction. We've been working with consistent working capital levels in the last few years, below historical levels. And the first quarter, as I mentioned, initially we will have some seasonal effect. So that answers a part of your question. And with this plan and the results we expect, we are preparing our leverage in cash for this period. It's undeniable that we have a lot of discomfort in cost. And these uncertainties in the macroeconomic scenario, and here in Brazil, this has been an increase in financial cost. And we'd just like to say that we have been sensitive to this environment. There are many uncertainties in the macroeconomic scenario, and the main driver in the company is the wood division, which is still performing well. But we've been telling you that we're looking at the possible alternatives in a scenario that is not so favorable in the short term. Right now, we don't have anything to declare or announce about anything that may anything that is already on our hands. We have some initiatives for cash and leveraging and some operational initiatives, some things that we would like to review in our balance. We have some mandatory actions. We want to reduce indebtedness. And we can show this in our statements later. But of course, the pressure we've been suffering is making us analyze everything we can do and compare it to our strategic horizon. So again, right now, we don't have anything to announce, but we would just like to say that there are many analyses that are necessary and mandatory to bring to the table. And all of these variables are starting to be confirmed to the negative side. So I don't want you to lose sight from the fact that there is a preparation for a year that is proving to be a little bit more challenging than we had expected. But we're still very confident that we have a lot to do, regardless of how the business is performing, to face this tougher scenario. Referring back to cash flow. So yes, there is a seasonal effect in the first quarter. I talked about balancing between the businesses before, because one of the main strategic levers for our business is also having positions in our working capital that give us a competitive advantage for our products and clients. So a part of this strategy involves moderate growth. So there are markets that are a bit more sensitive in service level. And right now, since we have a significant level of competition for this complicated scenario, we also have to make use of our positive attributes so that we have a good performance. So when it comes to sell in and sell out, especially in metals and sanitary ware, we're also looking at inventory levels to improve service levels and have more products going out. So working capital has been the first part of this effort. We are truly reorganizing ourselves for the year. The tougher scenario that we're facing is also making us assess some balancing alternatives for the year. As I mentioned, there are things we can do throughout the year. We can accelerate some kinds of inventory, reduce others, accelerate in certain sales channels and business segments. And throughout the year, we will need to pilot things so that our working capital is compatible with all of these uncertainties. So throughout last year, we started at 17%, and it was dropped down to 15 throughout the year, and we finished at 11%. We expect to have initiatives throughout this year to bring us to a compatible level without letting go of our service level. These are the drivers that help us have good and well-positioned products. Yes, that was a very comprehensive answer, and I'd just like to add a couple of things. The first is that it's not 3 to 4 times net debt to EBITDA. That scares us, but the cost of that debt. In wood and pulp and in the energy industry, this rate is quite common, but the fact is that this higher interest rate, the highest in 30 years, is putting some cost pressure on us, and that is unprecedented, especially for intensive capital companies like ours. What we can say is that we will see a lot of urgency from us to try to pilot this indebtedness, especially the cost of debt in our balance. So I don't have anything concrete to say, but from now on, you can definitely expect this from us. We are seeking alternatives to do things for this year. And the second key element is inventory quality. I think 11, 12, 15% working capital is adequate. And 15% is optimal inventory in metals. This is definitely the best result we can have. When you have a better service level, you can deliver quickly. And that's the best margins we have across our divisions. So it is worth investing in inventories. Of course, we need to fine-tune this and navigate this. As you see demand going down, of course, you can't continue to increase your inventory, and we need to pay attention to that. And I think we're very consistent at doing that. And the good thing about this is that we see good sell in and sell out in metals. And as sell in goes down, we change our inventory for our retailers, which is good for them as well. If you look at the balance sheet for the entire country, retailers are suffering. So if we can help them sell more Deca products, at the end, everybody wins. So this is the inventory position that we will continue to have because it is strategic. In ceramic tiles, of course, we don't need to have 60 to 70 days in inventory. So we are always going to be closer to 35, 45 days because it's a finished product. So we can be constant with this process. So I just wanted to add some color to that answer. And of course, reinforce that we do have a sense of urgency to look at leverage as an opportunity for all executives in the organization. Thank you, everyone. That was very clear. Thank you, Marcelo. The next question will be asked by Rafael Barcelos from Bradesco BBI. Go ahead, sir. Good morning, everyone. Thank you for taking my questions. The first question for Raul and for Francisco is this. I'd just like to refer back to leverage. Raul, as you said it yourself, the main issue seems to be the cost of debt and how financial expenses weigh on cash flow. So I just want to be more specific and direct here. Do you see any asset alienation in the forestry or in the factory side? How do you assess this as an alternative? And the company has been very successful in this kind of initiative in the past. So I'd just like to understand again where you see opportunities, if it's in forestry, manufacturing, and what would be the magnitude of this kind of opportunity in the past. It used to be relevant in the past, and now it's a bit more difficult to understand if there are opportunities of the same magnitude. So I'd just like to hear that from you. And my second question is about Deca and ceramic tiles. Raul, you are CEO and director for Deca Ceramic Tiles. So is there a plan to have another executive focusing on ceramic tiles, or do you want to continue in the same way? Finally, I'd like to ask a follow-up question on the profitability improvement process for Deca and ceramics. I understand that you gave us an update on the improvement plan, but just to ask a more specific question, internally, do you have any dates or expectations to close this gap on profitability for the ceramic tiles market with comparison to some competitors, maybe next year? I don't know if you have any perspectives internally, and where do you believe this improvement is coming from? I understand you have Botucatu, which will start this year, and that will be important for this improvement, but are there any brand positions or commercial strategies that you believe will be important? So where will this contribution come from to close this profitability gap? Thank you. So thank you for your question. So just to talk about this sense of urgency, considering the current scenario for several companies, including, we are going through this process of investments. So again, I don't think there's anything that we can say right now that is more robust, but I just like to say that when we look at the kind of leverage that doing this business requires to provide cash generation and better operational results for this kind of debt and the cost of debt, as we've been saying in the last calls, we need to aim at running below 2 times below the level of leverage, looking at net debt to EBITDA. In our case specifically, this assumes that there will be a measure, not, we don't have any assets in our balance that we can let go of to solve this issue completely. Any of these initiatives will require a kind of change in our business model to a higher or lower degree. And maybe it will need to be a combination of initiatives. So what do we mean? We now have a big balance because historically we decided to be at a very high production level for our business. And as a consequence, we have to carry some of the balance. In situations where you have normalized interest rates, growing at reasonable degrees, stability, and so on, this is perfectly acceptable. You depend on the speed of demand to generate results and to face the return on capital. But we know that Brazil is not a stable country. We have our significant ups and our instabilities. So when we talk about the business model for a stable environment, this would need more measures. But since we have this situation caused by Brazil, and since we are at this level of debt, things that were not feasible before become feasible. So I just like to say that because on our side, we are making efforts and analyses to see what is justifiable without compromising our long-term horizon. So again, we'd like to refer to this sense of urgency, and we'd have no vanity here. If anything requires significant change, if we need to focus on different kinds of assets and outsource things, and if we need to have a different composition of items and components manufactured outside the company, I mean, this is on the table. This pressure makes us have to consider this scenario. So we have to look at what we can do differently to provide good returns. In some cases, we are not necessarily talking about selling assets specifically, but transition to a different business model and then see what we're going to do with our assets. But I just like to say that we have a broad range of possibilities, and this applies to our business model. And this is justified, of course, by this current moment. So I've talked about the magnitude of this adjustment, but I have to look at the medium and long term into what we're aiming at, measured by this proportion between net debt and EBITDA, in order to keep a healthy horizon. Raul will answer your remaining questions. Thank you, Rafael. Let's start with the topic of the organization, as you mentioned. When we organized the company as we did, when I was nominated, that was the assumption. In the company's turnaround process, with so many things happening at once, our idea was to remain consistent. So clearly, throughout 2025, we don't expect any changes. We don't expect to have anyone heading the finishings division. We have a very robust leadership team there, operations, and so on. And we also have a very solid executive committee. So what we have been doing is prioritize very diligently the battles we select, our projects, what we're doing for this year. And each member of the executive board is leading a different initiative, including the ones involving Deca and tiles. So this is how we will operate in 2025. Considering cost and profitability, I just like to reinforce that there are some things that have not been captured in these results. So first of all, the reduction of costs. We can never go too deep into these figures for metals and sanitary ware, but we can say that sanitary ware has a higher profitability than metals. This is due to competition and costs. So we are reviewing the automation process in sanitary ware, and this is providing very good results. This will accelerate in 2025. 80% of the investments have been made, and now we are ramping up this investment in sanitary ware automation. This can give us about 10 points in quality when it starts. But of course, we're facing a tougher moment. The market is not doing well, so we are not making investments differently from wood, where we are capturing efficiency from the investment plan in Deca, and this is not happening yet. With Botucatu, you know that as a plant ramps up, you have costs, you have new products. When you have completely different products, this gets in the way of our profitability. But in Botucatu, we're not only looking at volume, we are trying to generate cash per machine hour. So we want to have higher value-added products that will provide sustainable results for the company. This is a journey for all of 2025 and 2026. There are new markets that we can start addressing. So Portinari and Bretta, which do not compete with the 300 million meters in the wet segment that we have. So it's a market of 50 million, but it's not totally addressable. So between 15 and 20 million is our addressable market. So of course we have some room to gain share here, but this would require changing some minds with architects. And finally, let's talk about the units that Francisco raised in a broader way. We have some units fewer, and we're trying to organize things so that our units have the right products for their vocation. So in Botucatu, they have 10 million meters, and they have to produce the best results looking at their capabilities. The same is true for Jundiaí. Most of our colored, we have the biggest plant for colored taps outside of China. So this, of course, will unlock the metals market. And there are many things that we can do in Brazil to provide profitability. So I think those are our main avenues. Operational improvements. This is a topic that is ongoing, but still depends on concluding some investments. And mix improvement for our main products. So I think this is making us expect better results. And I'd just like to reinforce that to a larger measure. If we look at 2023 and 2024, these were years in which we removed the main competitive gaps in our operation. And now we're going to 2025 with a different scenario. As investments mature, we will start having a competitive advantage. But we will need 2025 to balance the market scenario and be more solid. Great, thank you. Thank you, Rafael. The next question will be asked by Emerson Vieira from Goldman Sachs. Go ahead, sir. Hi, everyone. Good morning. Thank you for taking my question. I have two questions. First, I would like to understand the flexibility that the company currently has to adjust its CapEx level for the year. We know that the investment cycle is coming close to the end, but given the interest rate scenario that is still restrictive, it is still at a high level. So I'd just like to understand how much space you have to reduce this estimated CapEx for 2025. That's my first question. My second question is about costs. And I'd just like to talk about wood and pulp. In the wood division, we see a favorable cost dynamic despite the programmed maintenance that you have for the quarter. So I'd just like to understand if this level in panels is sustainable and if there are additional gains that you can seek throughout the next quarters. Also, looking at pulp costs, we saw a very favorable dynamic quarter on quarter. Revenue had a marginal drop, but EBITDA was basically flat. So I'd just like to hear about your cost dynamics in pulp as well. Thank you. Great, thank you for your questions. So first, flexibility on CapEx. We've talked before about cash generation, and so we scheduled things for a certain scenario. We, of course, knew it would not be easy based on what happened last year. So a significant part of our CapEx had already foreseen more restrictive signs of what we would be able to do. So I'm focusing on, of course, on our sustaining capex. In the sustaining capex, we had forestry, and this is the kind of action that would maintain our forestry base. And this is the kind of investment where we would have lower implications for the long term. It's the kind of initiative that if we were to look only at the number in capex, that wouldn't make sense. This isn't what we're seeking. But given it's a tougher scenario, we have to look at the remaining, since we have products where we have the opportunity to spend, we are postponing our disbursements. So there are a number of initiatives and options in this capex that can provide reductions for 2025, especially the ones that do not compromise our long-term options, where we can make disbursements over a longer span of time. So for 2025, the company is making this as a serious effort without compromising in the medium and long term. It's a tough scenario, but it's not a catastrophe. A catastrophe would involve other decisions, and this is not what we see in the current economic scenario. But there is some room to maneuver. When we look at our sustaining capex, it is not so significant, but this is we do have a plan for what we are going to disperse. So I'll let the question about would be answered by Henrique. Thank you, Emerson. When it comes to cost, we have been suffering due to this global variability. We have a couple of variables. One is related to raw materials, such as resins, and the cost of wood itself, which is a significant cost. When it comes to resin, we are still at a higher level than the last quarter last year when it comes to commodities. Exchange variation is another point that impacts us significantly. In the beginning of the year, we had a challenging scenario. We've naturally been making an internal effort. We have the price of raw materials and the consumption. So we are making a tireless effort to try to find the best we can to consume our raw materials. And this has been relieving our budget. So I don't see that we will have a more stable scenario. And of course, this is related to international trade. The only thing we can say is that we continue to have a strong effort in all productivity levers. And of course, we cannot stop. And naturally, because of this, we are looking at the market to try to balance our results. This is a very competitive market, and we are paying attention to variations in order not to have to go back on the advances that we made in the last few years. Yes, and just like to talk about dissolving pulp. Our cost performance in dissolving pulp has some components, but we have to remember that the exchange rate changed and it peaked in September. So for LD that is operating in US dollars, this converts all of our costs to a much lower dollar and gives us a an effect that we've been discussing since we invested in this project. So that is one factor. But the biggest factor is the productivity level that LD has been able to sustain month after month. And this has been translated into very different costs. In our reports, it's far below the first quartile, if it is not the first. So I would like to say that there's a component there that reinforces our business intelligence effort. We are capturing contract negotiations in favorable moments. So when there were instabilities in the second half and the first part of this year, we were paying attention so that we could capture these renegotiations in our results. So productivity and the plant's vocation to be highly productive have been confirmed. So I think that's a positive sign. And this just reinforces our contracyclical aspect. Thank you. Thank you, Emerson. This concludes the questions and answer session. We will now hand it over to Mr. Raul Guaragna, the company's CEO, for his closing remarks. Well, I'd like to thank everyone for participating and for your diligent work with our results. Your reports are always giving us good insight and also some tougher questions. And that helps us reflect on what we do every day. So Dexco will be 75 next year, similar to Itaú and Itaúsa. So that means that we have a long-term commitment in all decisions that we make. So you can expect a lot of energy, diligence, and a sense of urgency so that we can command things during this tougher time without compromising the future. We have a mission to sustain the business, and we will continue to pursue this with a lot of discipline. Just as we are looking at capital allocation, indebtedness, investments, and really no analysis or scenario will be forgotten in the short term so that we can be at healthier balance levels. Thank you and have a good day. This concludes the company's conference call. Thank you and have a good day.